Welcome to Real Estate in the Digital Age, or the REDA podcast. Real estate entrepreneurs Ryan Poole and Ryan Beckett bring you new content every week, reporting on market trends, industry innovations, cutting-edge real estate technology, and perspectives from the field. The future of real estate is here. Are you ready?
All right, welcome everyone to the REDA podcast, Real Estate in the Digital Age. We are back again for some great content. This time, we have a good longtime friend of mine, Gerald Pumphrey. He is in the mortgage space, and he's going to give us a significant edification on what's going on in the market. I know it's top of mind with everyone with interest rates, and he's a great guy to boot. So we're excited to have you, Gerald.
Thanks for having me.
Yeah, we're excited. Ryan, you want to kick it off with the first question?
No, we're glad you're here, Gerald. You've worked some of my deals as well. Always been happy with your services, and we're real estate in the digital age, and really find out here how the mortgage industry is changing, with technology and what's happening. So before we get into that, let's get the viewers to know a little bit about you, Gerald. Tell us a little bit about your background, your business, how long you've been in the industry, all those good things.
Well, I'll start off by I'm almost a Florida native. I've been in Florida since I was 2. My parents moved in 1972.
From where?
New York.
Okay.
New York. A lot of people moving from New York again.
Yes, a lot of New Yorkers.
That's the trend.
Seems to be half my clientele now.
Yeah.
Yep. And actually, 2023 is going to be a monumental year for me because it marks my 30th year in residential real estate.
Wow. Congratulations.
Wow.
So I'm either really good at it or I can't find anything else to do.
Yeah. It's fantastic. And a little story that I don't think even Ryan knows. Let's mention about my dad.
Well,
which is like a funny.
Yeah, I want to hear that. I remember you
backstory.
telling
Yeah.
me about that.
That's
Right?
actually how Ryan and I met.
That originally.
Ryan's dad was one of my first bosses back probably 20 plus years ago.
And you still talk to me.
And I still talk.
So you remember little Ryan Beckett?
Yeah.
Probably my dad complaining back in the day a lot.
No doubt.
That's good stuff.
Great
That's
to put
good.
a name with a face.
That's good stuff. So right now, you've been in the business for 30 years, and you've basically stayed in residential, right? No commercial, right? Okay, so all residential. And right now, you want to tell us a little bit about the company you're with and how that all came about, and then a little about your company?
Well, yeah, I'm with First Horizon. It's actually a bank, and if you do the ratings by size, we're currently in the top 50. They were founded in 1864, so they've been around a long, long time.
Wow.
And currently headquartered out of Memphis, Tennessee.
Okay. Fantastic. And you've been with them for a while now, right?
Just over 3 years.
And if I remember correctly, and a lot of people might not know, I mean, we have people in the audience that are realtors, brokers, investors, buyers, sellers, renters. One of the things that I learned when I came into the business that some people are originators, and sometimes they keep it in portfolio, and you have different access to different products, right? So with First Horizon, do you have access to potentially some products that other
Absolutely. That was the draw for me to come over because truthfully, almost every lender has a bunch of saleable products, and we all have the same. The difference between us is we actually have what I call our pot of gold, which is the money that we lend that's our own money. And it's a portfolio. Some of the things that we have that others don't have is we have an asset-based loan. Great product for someone who can show us 2 times post-liquid assets. So meaning if they're looking for a $900,000 mortgage, they have a $100,000 car loan, they have $1 million in debt, they show us liquidity of $2 million, we don't require tax returns.
Wow.
So it's more like common sense underwriting. Try and find that
Fantastic.
out.
Yeah, it doesn't really exist.
No, I know you've done. Actually, you guys have done a portfolio loan for myself.
Yeah.
Actually, I did a deal.
Yeah.
Go ahead.
Yeah, no, I was going to say it's great access because as an agent, you're always looking for that little bit of an edge, right?
Right.
As we're obviously in the industry of connecting with those service providers that can offer something a little bit extra.
Yeah. And I always said, mortgage lending I always look at it as a square box, and it seems like everything falls just outside of the box.
Right.
It's always a way of massaging it back in.
Can you mention a little bit about your medical doctor loans? That's always been interesting to me.
Yeah, that's a great product. In fact, we just enhanced it, but basically we'll do 100% financing for a medical doctor up to $1.5 million. They offer 95% up to $2 million and 90% up to $2.5 million.
Got it. And there's an interesting thing, not to jump around, but Ryan Poole actually made me aware of this. Are you seeing in this market with higher interest rates where the seller offers as an incentive to buy down the rate for the buyer?
I have.
You have?
I have, yes. Yes.
And do you like that? Dislike it? Do you
Well, I'm not opposed to it. I mean, I think it's great that, it's a little bit, the tides have turned a little bit. It's a little more even than maybe it was over the last few years. What I prefer more is, which we'll get into, I guess, is right now I think portfolio lending, meaning long-term adjustable rates, I think are really something that borrowers should look at. I mean, it's kind of been, no one's really looked at it. I mean, when you had rates below 3 for the last few years, why would you look at an adjustable? But the truth be told now, I mean, I'm offering 7-year rates that are in the high 4s, where a conventional 30-year fixed is in the mid 6s. So when you're looking at affordability today, that's a big difference.
Wow. And I guess we should just go right into it. So a lot of people have concerns about higher rates.
Oh, definitely.
Right?
Definitely.
So are you seeing a significant impact in your business as a result of higher rates, or is it somewhat...
Yeah, I mean, definitely. You've looked at the mortgage demand has definitely slowed. We're slowed to the point where we're looking at probably as volumes we haven't seen for some 20 plus years.
Yeah.
I feel that that's starting to change. I feel like the last probably 30 days, the market has seemed to have been like in a little bit of an uptick. I don't know if you guys are seeing the same, but there's a lot more people talking. I think there was an initial shock. I mean, when you go from, it was the fastest rates have ever.
I mean, from 3%. Like actually high 2s.
Yeah, there was.
I know. I had clients, Ryan, that were getting loans in high 2s. Yeah. You know what I mean? And now, I'm talking clients now, they're in the mid 6s, in less than a year, in about a year, right?
Yeah. Well, and in a 35, 40-day span, you had rates go from those 3s, we crossed 7.
Yeah.
Thank God it's retreated a little bit.
And I did a cash out refi at 3% to pay off some of my grad school, if you remember that.
Yeah.
Right before rates skyrocketed.
Well,
got lucky.
Being perfect timing.
It wanted perfect timing.
Perfect timing.
We were talking, I got yelled at before the podcast audience because I started talking about the economy, and the guys were like, we got to save it for the podcast. As we sit here in early December of 2022, I think that there was a lot of fear in the streets, literally and figuratively, of impending doom. And people that are market makers, influencers, were saying the writing's on the wall. And if you looked at just basic things that were going on in the market at large, it was hard not to fully agree with them and brace for impact, which I think a lot of people started batting down the hatches, which is cause for a lot of the freeze. Recent market data leads me to believe what economists call a soft landing. Still maybe a distant possibility, but seems to be a little bit more realistic. We just had a recent jobs report that just under 300,000 jobs were added. GDP surprisingly grew in the mid to high 2% range. Our budget deficit is still bad, but has been slashed. The Fed has signaled, correct me if I'm wrong, that they may cool off on the raise. Inflation has started to dip a little bit. It's still high. I understand economists don't like negative or 0% of inflation. They actually like 2% as a sweet spot. And all of that to say, and gas prices are down. They keep on coming down. Barrel of oil keeps on coming down. So all of that to say, it's not as bad as we might thought. It still could be bad. Let me qualify that. Yeah. But we look a lot better than we did even 2 months, 3 months ago. Don't you guys think?
No doubt.
Yeah.
No, it was Chicken Little. The sky is falling there from some influencers. They were saying, like you said, brace for impact. But I do see it, just as our own boots on the ground, Ryan. There's still people out there looking to purchase, right? And getting creative here with these loans, especially like an ARM loan. Like I remember those back in the day, but now they're coming back and they're more relevant. Just for the average listener, why don't you speak a little bit about that? Because you're talking a huge difference. So you're talking from a 6.5% loan down into the low 4s. So on a monthly payment, let's say on a $500,000 loan, which is your average sales price here in Palm Beach County now, what is that difference on that on a payment, Gerald?
Well, yeah, you could see easily $400 a month.
Yeah,
and the forecasts are, depend on the economist you're talking about, but now the Fed's tightening. They're lightening their language a little bit, but the forecast, they started at 2023. We'd see rates come back. Then I saw it extend out to 24, 25. So it doesn't matter who you talk to, but the ideal with the 7-year ARM or a 10-year ARM is it's going to give you a long enough window at that fixed portion before you even see a rate
So
fluctuate.
just to be clear for the average listener, because they might be hearing about this for the first time, it's basically that rate is locked in for 7 years.
7 years.
7 years, it can't change, and you have in that whole 7 years, if rates do come back down, right? So let's say they came back down below the 4.5% or even close to that, you can then refinance,
Correct.
right? And no prepayment
No
penalty.
prepayment penalty, which is pivotal.
And you may know the statistic better than I do, but what's the average length of time someone owns a home? I think the last time I checked NAR, National Association of Realtors, the average person owns a home 5 years.
That's
right?
what I had heard.
That's what you'd heard?
Yeah, I've heard 5 to 7 years as well, Ryan. So there you go.
So sometimes, it's somewhat moot, right? So you get that better affordability. The other thing that I sometimes find surprising is very intelligent friends and clients of mine sometimes don't look at the nuanced approach of owning a home, especially as it relates to primary residence, right? I was about ready to pay off my mortgage, and my financial advisor and my CPA said, "What are you, nuts? That's like the best write-off you had, and you didn't have enough write-offs. In fact, we encourage you to buy more real estate so we can depreciate it against your federal tax liability." So I dug in a little bit deeper because, as most people know, or if they don't, you can write off the interest on your primary residence. Now, without getting too much in the weeds, the way a 30-year mortgage amortizes, most of your payments early days is mostly interest.
Correct.
Right? So most of your payment is deductible. So, and not that it's a perfect balance of the two, obviously, but if you go from a 4% rate to a 6% rate, you're basically, and correct me if I say anything wrong, you're getting a 2% higher write-off.
Correct.
In essence, against your,
Correct.
So what I tell people, I go, your rents kind of track with property values, right? So now your building just increased your rent. You're paying $3,500 a month for a 2-bedroom in downtown West Palm Beach. You're burning money, right? You can't write.
We know people that this is happening.
That just happened to it. We talk to them all the time. And if you get into a primary residence that you have induced in savings, right? With inflation, assets are what help hedge you on inflation, right? Because if inflation's at 8% or whatever, then in theory, maybe not perfectly, the value of the assets should go up because it's taking purchasing power. So you're hedged on inflation with your greatest investment for most people, right? Now you have a significant tax write-off. So I've told my friends that are renting, I go, listen, I understand rates are a little higher, but this will be your primary residence. You'll get to write off most of your first 5 years because interest rates are a little higher. You'll have a little bit bigger of a write-off. Most of the people need it. Their businesses are doing well. So it's not all doom and gloom. You got to really zoom out, talk to your financial advisor, talk to your CPA, because when it was explained to me, a little bit of a broader picture, it's a no-brainer.
Yeah.
It's a no-brainer.
And two, that's different, I guess, because we lived through 2008. That was happening then when things were changing quickly. At least, like, the lending markets aren't constricting, right? They're not locking up. I mean, the money's still there. It's just the interest rates are changing. So that's one good thing. Like, the lending hasn't stopped, right? So people can still have access to
So it's a good point, and I say this in a little bit of jest, but I think a little serious. You know how Floridians, they kind of make fun of us when a hurricane comes. So we're like, we're fine, no big deal. People are like, you're going to stay? And everyone's like, I'm staying, And I think, because I started my real estate career in 2005, and I thought I was, hot stuff coming in, right? And then I went through the recession, and it was a big slap in the face, a big cold water shower. So I say all of that because it's almost like I went through that, so I see what's going on now. Because back then I had no doc loans to clients and friends. They were getting
negative amortization loans. We did those.
Negative amortization with no documentation.
No
appraisals were coming in sometimes over value. Some of my friends were getting money back at closing. Meanwhile, they had a $60,000 a year paying job. And at the time, you're kind of like, oh, I'm just collecting checks. This is great. But in retrospect, you're like,
yeah, that was going to end.
That was going to end. And when you saw what was happening, although nowhere near to what was going on there, in my opinion, you can't go on a trajectory like that because that's how bubbles form, right? And it's like running your car on red RPMs, right? You can't do it, right? Healthy growth is healthy, but too quick of growth, that's when you end up driving off a cliff. So I think the economy kind of needed it. We needed a cold shower. We needed to get more realistic. and the trajectory wasn't sustainable in a lot of people's opinion, not just mine. So not to be Pollyannish, but I think we're in a better position than a lot of other people think.
Yeah.
Oh,
What do you think, Gerald, like on that? Like, what percentage of loans that you've done now in the last 2 or 3 years, right, where we've had this run up, that are like 10, 20% down? I mean, they're like healthy down loans.
You mean as far as their equity position?
Yeah.
I don't know any, truthfully. I mean, the market, I mean, where they owe more than their.
Yeah, well, we don't have that, but all the loans that you have originated, most of them are putting 10, 20% down. I mean,
Oh yeah, yes, yeah. I mean, there was there really, other than some of the first-time homebuyer programs, there's no
FHA.
100% financing like
Yeah.
there was in the day, and everything's fully documented. I mean, we just
That's
talked
true.
about that. I mean, and that's why the same aspect isn't in play this time,
Right.
for the correction.
And when you recommend, unless it's maybe an FHA property with a 3.5% down or whatever it is, usually conventional wisdom, as I understand it, is you at least want to hit that threshold of 20%. Because then it's a conforming loan, and most people look at mortgage insurance, which if it's non-conforming triggered, and it's one of the few situations where you pay insurance to hedge someone else's risk,
Correct.
right?
Correct.
Yeah.
So a lot of people
PMI. insurance.
PMI, a lot of people look at that as just burning money,
Yes.
right? So usually 20% conventional wisdom is kind of the threshold you want to hit, right?
That still is. I mean, the big thing and where FHA has its mark today is still for the people with the lower credit scores, because what's happened over the last 2 years is the mortgage insurance companies have done risk rate pricing. So all your 800 credit scores, they're paying just a little bit in mortgage insurance now, regardless of their loan to value. I mean, it's all based on loan to value, but the FHA is not risk rate pricing. So I just had one yesterday, 620 score. Got to go, even though she had 20%, got to go FHA because her rate would have been a point higher and her MI would have been another $150 a month. So it still has a place even for people that have 20%. But that's what you said is correct. Most times that's the number one spot.
And do you still have that program I really liked, the new construction one for primary residence? Can you tell the audience a little bit about that?
Yeah, that's been kind of a big product of late because a lot of people, with the way the values have gone, they're actually staying in their houses. So it's not just people think of a construction loan, oh, I'm buying a vacant lot and I'm building a house. What we're seeing mostly now is somebody that's got a house and it's just not big enough. So they need to add a second or third bedroom, a second floor, whatever it may be. So we do rehabs under that program as well.
Interesting.
And we have the construction term. We give them 24 months to build, which is huge. A lot of lenders out there, I would say, are between 12 and 15 months. And with the supply chain issues we've seen over the last year, that extra time to build was definitely needed.
And then once it's finished, then you just refi out of it. And
Well, no, actually, they just roll. So
it just rolls right
it's a
in.
construction perm. The
Oh, wow.
perm means as soon as they can get interest only, 24-month periods over.
so there's no more other closing costs
Nope,
or anything.
no
That's great.
duplication and cost.
And on the other one, say someone finds a lot, correct me if I say anything wrong. So they can acquire
Yep.
with the loan the lot. They have a construction drawl of some kind, right, with the construction. And once you get your certificate of occupancy, then it rolls into a normal 30-year amortization mortgage, one closing. One closing. You don't have to do additional origination points, everything for primary residence, correct? Yep.
I'm learning
That's
this one. This is a good one.
That's a
Gerald.
solid
I didn't-
product, huh?
That is a good product.
Yeah.
Definitely great.
Because, with
I mean, there's still lots out there like Jupiter Farms. It's a great thing. Loxahatchee. There's still lots available for people to build homes on.
what if there's a teardown? Is there a demo?
Correct. Yeah, you could do the same.
Oh, really?
Do the same thing.
So if it's a teardown, you can factor in the demo in the loan too, which usually demos are surprisingly cheap based on what I.
They really are.
Yeah,
You
yeah,
think
yeah.
it's a lot, but it's not.
Yeah.
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 But the big thing with that type of loan is it's just they always use on a construction loan, it's always the lesser of acquisition cost or appraised value.
Okay.
So Pool's going to love this one because he's big on collateralization. Can you speak of what you mentioned to us in your notes a little bit about the cross-collateral loans?
Oh, yeah, cross-collateralization. Those are great loans, one of my favorite products. And it's just, of late we had people, and you still have people that, don't really want to have open houses while they're living in the house. They don't want the stress that their house is sold and they have, a 30, 60-day window to find something else. And
Right.
in the tight supply market we had, that's sometimes not enough time. So with the cross-collateralization, what we've done is we've come out with a product where basically we'll give somebody up to 100% financing on their new purchase. We'll cross-collateralize whatever the agreed upon term. Let's just say it was 20%. So let's use the 20%. That's the ideal. They have 20% equity in their house. We'll put a silent lien on their house. Doesn't require payments.
Can you tell us what a silent lien is?
Well, yeah. Okay, so let's just say we need $100,000. Once they sell that house, we'll put a $100,000 lien, but there's no payments. It just sits there.
Okay.
It's only payable upon sale.
Okay.
Okay.
So basically, we give them the 100% financing up front. Once their house sells, that's a second mortgage that'll get paid off, and our new mortgage would be brought down accordingly.
And this is done by appraisal on their current home.
Correct. We will appraise it, so obviously they have to justify that they have that equity in there, yeah.
Fair enough.
Yeah.
And it's 20% is all the equity they have to have?
Depending, yeah.
Yeah.
I mean, let's use it as a gauge.
Okay,
In certain cases,
that's
we
a
could
threshold.
Do 10. We could do 10. Yeah.
Okay. Oh, wow.
Yeah.
Wow.
I know there's
We
so
should
many
be-
there's so many buyers. I mean, buyers out there that are looking to sell their home that are sitting on this nice chunk of equity, and now you don't have to worry about necessarily having to sell your home to buy another one.
You
My wheels are
you guys
turning.
know that it's a stressful process. to
My
sell
wheels
a
are
home.
turning. This is a
People
great
get-
tool for us as brokers, and I'll tell you why. As I'm thinking about this, one, you have this situation all the time, as you alluded, right? And two, it helps us because a lot of times they sit in a home because they want too much for the home,
Yes.
right? That's usually, there's a number of factors, but that's a big reason, right? So
Going
now,
through it now, yeah.
now, because it's hard to convince a seller to get an appraisal to go into listing, right? Now they have to get an appraisal.
Yes.
Right. So now it's all on the table, right? And sure, we can make a thing that we can list a little above appraisal, but now it's not me doing my broker opinion and telling them what I believe the market and understand the market to be able to support. Now we have a third party giving an appraisal on the property that they want to sell to go buy another one. So from a brokerage thing, one, it's a guaranteed seller. Number one. So as a broker, as a realtor, you're spending your time wisely. They're not going to jerk you around and just see what the market's like and fish and float it out there. Two, you have the appraisal, so you have a realistic price, an honest price, right? And you can, but at least you have that as a talking point. And then they're already in a new house. That's a perfect sellable listing. You have a motivated seller now.
Definitely motivated.
We got to talk more about this. Okay. Good. So since we're the Real Estate in the Digital Age podcast, I know you're old school, and in terms of contact, you love your cell phone, and that's honestly probably the best way. And I've said this before on the podcast. I'm guilty of it because I love tech. I'm the guy that will wait around the corner overnight for the new iPhone kind of guy. And people like me tend to have a mentality that tech is a hammer and everything looks like a nail. And sometimes I try to be cognizant of that with my agents that tech isn't always the answer, right? And if we're being honest with our audience in the podcast, sometimes, depending on the situation, it's better just to do it the old school way, right? And that's good.
Build relationships.
Build relationships. And all of that said, is there anything that you're seeing as it relates to tech in your industry, your company, the industry at large, that you are excited about, you think's great? Shoot, even it's something you think's not working in the world with tech.
Well, I think tech is, I don't think there's any stopping it.
Yeah.
And I definitely think, I'm just always amazed. I'll have 80-year-old clients that just, no, don't email me anything, just give me the webpage. I just want to do everything online. And I think that's kind of fascinating that that more and more buyers and borrowers are looking for the online experience. Yeah. And, most of these platforms now, they're just great. The borrower can apply online. They can view their documents. They can get their loan status online, and then they can electronically sign their documents. Obviously there's a lot of talking that goes on between in the middle of a transaction between a realtor, a lender, and a borrower. But in the end of the day, there's a lot that technology can help and ease.
Got it. And how about your bank? Are you guys using any online platforms? Do you guys take applications online? Is that kind of
everything? Pretty much every loan is an online application at this stage. Yeah, and disclosures go out online. Everything is automated.
Got it. And how about once it gets past you and it starts working with the title company and all of that? Is that more of a digital tech experience? Still kind of
that? I would say no. Because most of I would say the title companies. Not everybody's on the same platforms, so I see that still a lot of emails.
Got it.
A lot of emails back and forth.
Title Leap needs to get the lenders on there, so they would have the agents, the buyers, and sellers on there,
right?
But they didn't see title on the lenders on there yet.
Yeah, we'll talk to you about that after the podcast. It's another person we had, Jim Brown. He's got a really awesome, somewhat of a transaction management for his title company. Is he white label? Is he going to white label that, or is he keeping it proprietary?
I'll let him answer.
Okay.
I know he's looking at a couple different models.
So their paralegal takes the contract, updates it. They have an app online thing. So anything from sending escrow deposits in a secure internal system to all of your critical dates. Because if you have a lot of deals going on, it's sometimes hard to remember when that second deposit's due, the day of the inspection period, financing contingency, all that. So everyone, you, realtor, seller, buyer, push notified. Wow. So if anyone's like, oh, you didn't tell me the financing contingency was ending, we're like, here it is. Here it is. It's all there. And if nothing else, a little jingle for us, sometimes. And then you had to count the calendar days. Maybe you didn't count the right day for you know what I mean? It happens, especially when you get 30 days out. Interesting. All right, Poole, you want to take the next one?
Yeah, so I guess, do you see any other kind of things coming down the pipe as creative solutions with the interest rates getting? I know we talked about ARMs. Is there any talks of like, I've heard some rumors of a 40-year loan. Is there any other kind of?
I've heard the same. I just haven't really seen it.
Okay.
Yeah, like where it's like they're testing it, because that's when I consider it a real product, is when they say, okay, we just released a pilot. That I haven't seen yet. Yeah,
okay.
But there's a definite need.
Yeah. No, it's it's one of the things. I mean, that's when it comes down to it. It's like that monthly payment. It's like, what can the homeowners afford? Because obviously, everybody love to pay cash for real estate, but it actually, when you dig into it, as Ryan suggested, it's not the best thing. You have great tax write-offs with your mortgage, so many great things, but still, at the end of the day, you have to have that monthly payment that's affordable.
Yeah, and I hate to say it, but the auto dealers have done it. Remember back in the day, it used to be a 4-year auto loan. Now you're seeing 72 months, 84 months. So.
Well, if I remember, I think I did a business school study on this. So Ford with the Model T was the preeminent gargantuan thing, and GM was trying to get some market share. So they rolled out GM Credit, where you could finance your car, pay later. That was the first introduction, and they just boomed because smaller payments. You could get into ownership, and that was their big thing, is the financing arm. And even a lot of department stores do it, right? They make a lot of money on their credit.
Oh, they do.
Right.
They all have the credit cards, right?
Yeah.
It's like they'll give you that 0% introductory offer, but then you forget about it, and then all of a sudden, boom.
That's, yeah.
So let me ask you this, too. We love to, like, especially as agents, what do you think the Fed's going to do with the rates here? I mean, let's take your crystal ball out, Gerald, and you predict. Where do you think it's going? I mean, everything that you're looking at, what is your feeling?
Yeah, well, I mean, I have to go with what Ryan said earlier. I think the signs are there that hopefully inflation is easing.
Mm-hmm.
The jobs. I just think that probably more towards the second quarter of next year we could see an easing.
Mm-hmm. Mm-hmm. Do you think you could see rates go down next year?
I do.
Wow.
I do.
So I think people like me and people like you, when people start to think that, they start to ask me questions about waiting, right?
Yes.
And that's the thing. I'm like, if we had a crystal ball, I could make us all very, very wealthy. And I told friends back when interest rates were at 3%, where they were waffling on for example, I had a conversation about a $700,000 home. I go, listen, even if the market softens, the Fed what markets don't like is surprise. So what the Fed does is always try to thread the needle. They're like, hey, we're thinking about raising rates one quarter. Hey, we're probably going to raise rates the next quarter. Next quarter, they're like, yeah, we're going to raise rates, right? And I believe in terms of easing and stuff like that, there will be a drumbeat going there because they don't like to surprise Wall Street. Wall Street markets don't like surprises. But what I told them in that instance, I go, listen, when interest rates go up, this is one of my friends that's renting and paying a lot of money. I said, when interest rates go up, the price of that home effectively is going to be $900,000, right? Because now your interest rates are higher or whatever. And by the way, you're not getting, because this will be your primary residence, you're not getting that write-off against your taxes. So not to be like a cliche realtor and say always the best time to buy is now, but I think if you're renting and whether the rates go down, you can always refi, right? To your point. So if there's a significant delta from the higher rate to the lower rate, it's always in your quiver to be able to refinance. So maybe I will sound like a cliche realtor.
I know.
No better time to buy
but
them
I'm
now.
just saying, like the ARM, like you said, you're in 4.5%.
That's true.
The next 7 years.
Yeah.
You got plenty of time. And I think the opportunity, I've been working with a lot of buyers just on a personal level too, is they're all like, oh, we're going to wait and see maybe after the first of the year and see what things are happening.
Mm-hmm.
But can remember there's still a little bit of fear right now in the seller's minds. Now's the opportunity. You can make an offer. Just had a deal, got a great discount on it, and you can make an offer and see what happens. Versus if you wait and things do, change and the rates don't go up and things start to unlock a little bit, then it's going to be harder again to find a deal.
Yeah, and even though it seems like inflation could be softening and maybe going the other direction in the correct way, like I said, if you get into an asset, inflation in theory is built into your assets, right? So you're also hedging yourself on high inflation, right? So that's just my 2 cents.
No, it's good. It's good. So it's just been great. I hope the listeners have been getting incredible value. You've shared a lot. I mean, I've learned stuff here.
Well, I learned something.
I know.
I didn't realize
this
that
construction loan actually is very, very interesting on this one.
the collateral loan I'm going to call them all day about.
And the collateral loan too is 2 good ones here. But hey, you've been in business, Gerald, 30 years, right? Like, what are some tips? And obviously, a lot of our listeners are real estate agents. I tell everybody they're the OG entrepreneurs, right? That they were out there building their business. What's some tips that you could give them that you feel that applying your own business that you've done for 30 years that you would give someone?
Oh, well, I think actually just always doing the right thing for your client is what really gets your clients to appreciate what you do, refer you, and it keeps them coming back year after year.
Yeah.
I mean, because let's face it, in our industries, there's a lot of transactional real estate agents, there's a lot of transactional mortgage brokers, but in the end of the day, this is a big investment for people, and you need to make sure you're protecting their investments.
Yeah, I see a lot of people in life and a lot of different venues going for the short term, right? And if you zoom out and look at the long-term plays and not just, to your point, like something that's transactional, I've done certain decisions in my career where it definitely wasn't the most lucrative for me in the short term, but it's funny how, and I love that this is the case, how that kind of pays dividends down the line, because that client or that real estate agent or that friend or whatever just appreciates that I didn't do that money grab at that time, right? And they're like, hey, and that's how you get loyalty.
That's the truth.
Right? Yeah.
Yeah, it is. So like you said, I mean, a big thing is referral business, right? I mean, that's, work those referrals, agents, people that have done business with you in the past and keep doing that.
It's the most sticky, right? Like there's all kinds of business approaches, on one end of the spectrum, there's the agents that call expired listings, right? Like it's a racket. You got to work your butt off. It can be effective, but it's a numbers game. It's a low conversion rate, and you know that going in. Then, the kind of business that I've been into, because I'm low volume, more of a high price point, and I'm more like in the lifestyle of that equestrian world, it's word of mouth. And that's sticky, whether it's a referral or it's repeat business. That's at least what I've learned for sure. For sure.
Definitely.
What do you think? You want to do that last one, or you think we covered it?
Yeah, no, we've done anything. Is there any where do you see your business in the future, Gerald? Where do you see things going in the future for you and your business for the mortgage industry?
Well, health, as long as the health stays there, I plan on doing this as long as I can.
Really?
Yeah, I still love it like I did the day I got into it. And the only thing, I just want to free up some more time maybe get a little more out on the golf course.
There you go.
See if I can't shave a few strokes off.
There you go. What would you say, out of curiosity? I've never asked you this question. What's your favorite part? Like, what gets you up in the morning for your job? Like obviously it's providing, for me, a livelihood and being able to pay the bills. But is there something beyond that gets you out of bed or that you really enjoy?
Yeah, it doesn't happen every day, but I think what I really strive and what I love the most is when you get someone who calls you and say, hey, listen, I've been declined by XYZ, or I've been declined by 2 or 3 different people, and you work with them and you figure out a way to get them in. And it's just, I don't know, to me, it's just trying to work something that everybody else said is a no-go,
right,
and get it done.
Yeah,
that's
fantastic.
I mean, that's life-changing for people. They're not a renter anymore. They're a homeowner.
It literally is.
I mean, literally life-changing.
Yeah.
No, that's amazing, Gerald.
That's fantastic.
So great. So how can people connect with you, Gerald?
Well, we said best contact for me is always my cell phone. Email, Gerald.Pumphrey, firsthorizon.com. And then I also have a First Horizon webpage.
Fantastic. Do you do any social?
not as much as I should.
All right, we can help you.
Yeah, we got to get you on Real Trade, man.
Yeah, for
Get you
sure.
connect others. They just need to know about the products that you have.
For sure. Well, if you ever want to get on the golf course, if you want to take my lunch money, we definitely need to connect.
Deal.
We need to connect on a lot of these products too, because like Poole said, I even learned something today. Some great products out there. It's fantastic. So thank you, Gerald. Thank you very much.
Thank you very much for having me. Appreciate it.
Yeah, thanks, Gerald.
It was great. You gave the audience some great information. So with that, thank you for listening to the REDA podcast. As always, please like, subscribe, and tell your friends. We're just trying to provide value, anything we can. Investors, buyers, sellers, renters, landlords, all of it. So any feedback, we're always happy to hear it. Listen, any guests you want to have. What's our email address, Ryan?
The REDA podcast
at gmail.com. The REDA podcast at gmail.com. And we're on all social handles, REDA podcast. Thank you, guys.
Thanks.
Let's get in. Let's get in. Let's get in.